This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello. Robert Kiyosaki, the Rich Dad Radio Show. The good news and bad news about money. And today we have the single most important show of your life. And the reason for that is we have a very dear friend, but in my opinion, one of the greatest minds of our times. You know, there are sages of the time. And this gentleman, our guest today, is that person. I mean, some of you have heard of him. His name is Jim Rickards. And I started with his book, Currency Wars. I've read all of his books up to that. The other thing I like about Jim is that he puts his books on audiobooks, and I can actually hear him read his books. So I was listening to Road to Ruin all the way through Montana. And it was the most exciting but frightening book I've ever listened to on audio tape. I'd already read the book, but to listen to Jim speak it was incredible. Any comments, Kim?
Well, Jim's one of the smartest guys we know, and what's fascinating also is that he was a national security advisor for the Pentagon and the CIA. So there's probably things he can't tell us, or he'll have to kill us. So no, just a super good guy. And author last book he wrote was the New Case for Gold. He wrote Death of Money, Currency Wars, Road to Ruin. His latest book is called Aftermath, and it was published 2019. I think we're in the aftermath. We'll find out. And one last thing, too, is Jim also has a financial newsletter, and once you hear this interview, you're probably going to want to sign up for it. It's called Strategic Intelligence.
So let me give you the agenda, because we only have two 20-minute slots. So Jim has been calling, and he's not a guesser. He is a mathematician. He's unbelievable. He's calling for gold to hit $15,000 by 20. And so he doesn't guess at it. He's not pulling numbers out of there. He's not trying to sell gold. He's not doing anything. It's just the way his brain works. So the question today, these are the four questions I'm going to ask Jim in these two 20-minute slots. And I call them the fire hose, because once he gets started, you can't stop him. So I'm not going to interrupt him. So first question I'm going to ask Jim is, what does the rising price of gold mean? See, it's not good news. Gold hitting $15,000 an ounce means something is really screwed up in the economy. So he's going to be talking more what's behind the price of gold. Number two is, why is Buffett dumping bank shares and buying gold and silver? The third question is, what's the difference between bonds versus gold? And four is, what does he expect, inflation or deflation, and subjects like that. So those are the four questions. So stay tuned to this most important Rich Dad radio program for your financial future. So welcome to the program, my friend, Jim Rickards.
Welcome, Jim.
Thank you, Robert. Thank you, Kim. Thank you for the very kind introduction.
Thank you. So question number one. Okay, so you're calling for gold to hit $15,000. And if anybody wants to find out Jim's logic behind it, he goes into great detail on YouTube about how he derives $15,000. My question to Jim is this: what's causing that? You see, there's something very, very sick inside the economy and in our monetary system to be driving gold that high. So question number one, Jim, why is the price of gold rising? What's going on in the economy?
Right. It's sort of a two-part answer, Robert. One is exactly as you put it. Why is gold going up? What's going on? What's the basis for predicting $15,000 an ounce by 2025, which I do. But then also, well, what does it really mean? Is that you said it's not a good thing, and I agree. It's not a good thing for the economy. It's not a good thing for most Americans. If you have gold, you can pat yourself on the back and say, yeah, I made a lot of money on gold. But that might be in a world where you're losing a lot of money on other things, and you need to be alert to the overall economic picture. So let's take this one at a time. You know, the gold $15,000 an ounce, it comes out of three different analyses that actually don't correlate to each other. In other words, you do it one way, you get a number, you do it another way, you get a number, you do it a third way, you get a number. It was interesting that they all came out not exactly to the penny, but very close to that $15,000 number. So the first way to do it is just, it's a little bit of technical analysis, not overly technical. We're in the third great bull market in gold in history. When I say in history, you're like, well, gee, history is a long time. How come this is only the third bull market? Well, the answer is for almost all of history up until 1971, gold was money. So you didn't have bull markets or bear markets. It was just gold. That was the money. And you thought about it by weight. You say, well, I'll give you an ounce of gold for this property, or I'll give you, a quarter ounce for, some food or groceries or whatever. So you thought about gold by weight. It was money, constant store value. So it's really only since 1971 when Nixon suspended redemption of dollars for gold by our foreign trading partners, that gold just went its own way, detached from the dollar. So the dollar would do what it was going to do, and gold had its own market and still does. The first great bull market was 1971 to 1980. And gold went up over 2,000%, from $35 an ounce to $800 an ounce in January 1980. Then there was like a long, drawn out, almost 20-year bear market from 1980 to 1999, and gold dropped down to around 250. So it went from the 800 level down to 250. The second great bull market was from 1999 to 2011. August 2011, gold went from $250 an ounce to $1,900 an ounce. That was an almost 700% gain. Then the second bear market, August 2011 to December 2015. The third bull market, I can give you the exact date, December 16th, 2015. Gold hit $1,050 an ounce. That was the bottom of the second bear market I described, a pretty steep fall from the 1900 level. But you could tell it was the bottom. You say, well, how do you know that? I had a conversation with our friend Jim Rickards, one of the greatest traders in general, and certainly one of the greatest commodity traders of all time. And this was before that market bottom, when it was still going down. And I said, Jim, we were down in the Dominican Republic. I said, Jim, you buying gold? And he said, no. He said, I've got gold. I'm keeping the gold I have. I'm not buying more right now because it hasn't hit bottom. And then he gave me one of the best pieces of advice I've ever had. He said, Jim, nothing goes from here to the moon without a 50% drawdown along the way. It'll get there, but it'll go up, down 50%, and then back up for the really big, sort of hyperbolic price move. We said, and you have to expect that. It's true of all commodities. Well, taking that advice, I then, looked at the charts. Well, starting at 1900, if you say, okay, it was 250 was 1999, 1900 was August 2011. So there was that gain. 250 to 1900. So there was that gain of $1,650 an ounce of gain. Take half of that, that's 825. So take 1900 minus 825, and guess where you come out? You come out right at 1075. And so when I saw 1050, I said, bingo, there's the 50% drawdown. It's exactly what Jim Rickards said would happen. That's the bottom, and it's up about 50% from there. Now, it's been a little bit higher than that, but it's up about 50% from there. So there's your third bull market. But here's the point, Robert. If the first bull market was up 2,000% and the second bull market was up 700%, if you just take the average of those two, you don't have to pick the higher of the two. You don't have to go crazy. Your sale will be bigger than ever. It could be, but you don't have to do that. If you just take the average of those two, you would come up with a number around 1,400% gain from the 1050. Well, that would put you at almost $15,000 an ounce. So in other words, and the same time period, the first bull market was 9 years. The second bull market was 12 years. Just take the average, you get 10 and a half years. So from December 2015, just using the averages, not anything crazy, 10 and a half years up, 1,500%, bingo, puts you at $15,000 an ounce in 2025. And by the way, don't wait. If you agree with that analysis and there's more to back it up, don't wait until 2025. People say, oh, okay, well, it's going to be $15,000 an ounce. I'll go out and get it in 2024, I'll catch the wave. No, it's a long way between here and 1,500. I mean, you got to get to 3,000, 4,000, 5,000, 6,000. 7,000, et cetera. You got a long way to go to 15,000. So why not get the gold now, which I do recommend, and then enjoy all those profits. Don't wait to the end, because it could happen. There could be like spike at the end. So
and by the way, gold's approximately with premium about 2,000 an ounce.
correct.
So it sounds expensive today, but at 2025, you're going to say I should have bought it in 2020.
Yeah, I should have bought it in 2015, but that's okay. Most of the gains are yet to come. The other thing that people don't understand, Robert, is just this is sixth grade math. You don't need calculus for this. Each $1,000 gain is $1,000 gain. If you have an ounce of gold and it goes up $1,000 an ounce, you just made $1,000. That's real money. But because you're working off a higher base, each $1,000 gain is a smaller percentage than the one before. So when you move from $2,000 to $3,000 an ounce, that's a 50% gain. But when you move from 14,000 to 15,000, it's only a 7% gain. So that's why these bull markets get a lot of their gains toward the end, because 7%, that's a week. And then you're not going to, you might have to wait a while to get to 3,000, but if you're at 14, you're not going to wait long to get to 15. A 7% could be a 1 week rally. So in other words, those $1,000 increments are smaller percentages and easier to achieve the further along you go. So, one more reason to get the gold now.
So that's why you've talked about it. It goes parabolic. It goes.
Correct. But again, $1,000 is $1,000. It's the same amount of money, but it's a smaller percentage, which means it's easier to hit. And so the hard work is right now kind of getting to 3,000, 4,000, which it will. But it can really take off from there. $100 days are going to be the norm. $1,000 weeks are not going to be unusual, and they'll be more and more frequent as we move along. So that's one analysis. The second analysis is if you just use a monetary analysis. I'm not saying we're going to go on a gold standard. We may. Right now, there's not a central bank in the world that wants a gold standard. Not one. They hate it. But they may be forced to go to it or something like it, because if confidence is lost in government money and fiat money, they may have to turn to gold, not because they want to, but because they have to restore confidence. So what's that math? Well, the global money supply is about, I'm using M1 and the major economies, which is about 80% of global GDP, is about 33 trillion. And there happen to be about 34,000 tons of official gold. That's not all the gold in the world. That's the official gold held by central banks and so forth. Well, you just do the division. Okay, divide the 33, take the 33 trillion and just say you need 40% backing. Some people would say 100%, but historically 40% has worked pretty well. So you need about 12 or 13 trillion dollars worth of gold to back up that money. Well, if you have 34,000 tons and you need about 13 trillion dollars of gold to back up the money supply, what does that come to? We'll just divide by one by the other, and again, you get a number close to $14,000 an ounce. So there are two completely independent methods. One is the technical historical look. The other one is a monetary look based on money supply. But interestingly, they come out in the same place. And then there are other ways of getting to the same answer. So that's I feel very strong. I feel it's a very solid kind of analysis to get to that number. But the other part of your question, Robert, is, okay, what does it mean? Isn't this great? Well, gold's going up. I'm making a lot of money. Well, maybe you are, and other people are who have gold, and I certainly recommend it. But to me, the price of gold never changes. I think of gold by weight. You have an ounce, you have a kilo, you have a ton, you have a 400-ounce bar, whatever you may have. If the dollar price of gold is going up, what's really happening is that the value of the dollar is going down. Because gold is a constant store of value. So if all of a sudden, if $2,000 gets me an ounce, but we get to a world where it takes $5,000 to get me an ounce, what happened? The value of the dollar went down. I need 2.5 times more dollars to get the same ounce. So a high dollar price of gold is again, good for gold holders, but not close for celebration, because it means the complete and utter collapse of the US dollar. That's what happened in the 70s, and that's what's happening now.
And so then the next question is then, Buffett, who has really trashed gold for a long time, he also trashes Bitcoin. I think he called it rat poison or rat droppings. He called Bitcoin that. And I kind of laughed because he also said the same thing about Apple stocks. But Warren Buffett, he just started selling his banking shares, and he bought into Barrick. So from Jim Rickards' point of view, what do you think is going on in Buffett's mind? Well,
a couple of things. The reason for dumping the banking shares is, I was the counseled Citibank for 10 years, so I know a little bit about the banking business. The way you make money is you borrow short and lend long. You borrow at a low rate and lend at a higher rate, and you keep the difference. You got fees and credit losses and lots of complications, but that's pretty much what the banking business has always been. Well, if interest rates are zero all across the yield curve, in other words, if you're borrowing close to zero, maybe 25 basis points, and you're lending close to zero, maybe 1% or less, how do you make money? The answer is you can't. You can make a little bit of money, you can leverage it a little bit, but you don't make enough money to cover your credit losses and your expenses and your overhead and fees and a lot of other costs associated with that. So the flatter the yield curve, here's a 10-year rate, here's a overnight rate. If it's like this, you can make all this money in between. You're taking risk in terms of timing, but you don't have to take a lot of credit risk. But if it's flat, you can't make any money. So he's dumping the banking shares because they can't make money. Why would you buy Barrick? Well, he obviously likes gold. That goes without saying. But Berkshire Hathaway, which is Buffett's investment vehicle, is so big. We're talking, upwards of $1 trillion. You can't buy junior miners. Junior miners can be very, very attractive investments, but they don't move the needle at Berkshire Hathaway. You got to be spending $500 million just to kind of get on the list. Well, there are only a couple of mining companies in the world that are that big. Newmont, Barrick, IAMGOLD, there are a few, but that's it. So Buffett's not going to be buying junior miners anywhere. He doesn't have the time and the ability to attract them. He needs a big name, and Barrick is one of the best. Interestingly, the way Barrick's going to make their money, they'll make money in gold for sure, and their stock price will go up, and it's a smart move by Buffett. But they're not going to make it by exploring. They're going to make it by buying junior miners. That's why for an investor a little bit smaller than Berkshire Hathaway, the junior miners can be attractive.
So Barrick will start buying junior miners. That's the
plan. They don't have the time to go out and explore and produce and take all that risk. They'll just wait until other people do, hit a good gold mine, prove it out, start mining, start producing, then they'll just buy that company and add it to their output.
So how much would Buffett be thinking about the price of gold rising? So, Kim and I started a gold mine in China, which was a big mistake. But anyway, because they took it.
Yeah, right.
And they took the gold in the ground. They didn't take our mine. They just took the gold in the ground. How much of Barrick's, huh?
They put their straw in your milkshake.
Exactly what they did.
Well, that's called help yourself, Anyway, but what was I talking about? I'm still a little upset about that, Jim. But anyway, the point is here, he's buying gold in the ground too, in the anticipation of gold going up in price. Is that
sure? Yeah, I mean, and for that matter, a gold mining company is a leverage bet on gold just because of the economics. You have fixed costs and variable costs. Well, once you cover your fixed costs, and assuming you can control your variable costs, as the price of gold goes up, all that money goes straight to the bottom line. Initially, you got capital costs and leasing and geological surveys and all kinds of things. But once you get producing and you cover your fixed costs, a lot of the incremental price of gold goes to the bottom line. The stock market gives you a multiple of that. So the answer is, if gold's going to go up 5 times, which I expect it will, or more, a mining stock could go up 25 or 50 times just because of the economics of stocks versus gold.
So let me get just a question back to the banks. When you're saying they're not going to be able to make money, what's your prediction on banks? Are we losing the banks? Is their system going to change?
No, the banks are necessary. They may not be everyone's favorite institutions, but they are necessary. The big ones will not be allowed to fail. We know they're too big to fail. So they're almost like utilities, like the electric company or the phone company or something like that. They're not going to fail, but they don't have to be particularly profitable. And that's what Buffett's saying, is that you'll be around. Citibank will be around in 10 years, but may find it extremely difficult to make a lot of money in this environment. So get out of it.
Okay, it's Robert Kiyosaki, Rich Dad Radio Show. We're talking to a great friend and person tremendous respect for, is Jim Rickards. Get his books. I mean, every time I read his books, every book is different. It just blows my mind. It's how big this world of money is.
And also his financial newsletter, Strategic Intelligence, is chock full of lots of Jim Rickards.
Wisdom.
Lots of wisdom.
Years of personal experiences. And the thing, some of his books, he talks about being with the CIA and what he saw from the inside. Holy moly. I mean, what he saw from the inside it's worse than you think. So he's he's much of a gentleman. He doesn't name names, but there's a lot of Frito Banditos out there running our economy. So when we come back, we'll be asking Jim 2 more questions. What's the difference in bond versus gold? And are we looking at inflation or deflation? We'll be right back.
Have you heard about the expanding influence of BRICS, Brazil, Russia, India, China, and South Africa, and its potential to severely impact the US dollar by possibly creating a new world currency? Even JP Morgan said, and I'm paraphrasing, the impact of BRICS would most likely be felt here in the US, where moving away from the dollar would cause our financial assets like our IRAs and 401ks to lose value. We agree with JP Morgan and many others. Now's the time to position yourself for stability, security, and wealth protection. So take it from Robert and me, whether you're a seasoned investor or just starting, we believe that gold should be a part of everyone's portfolio. Seize the opportunity to ensure your financial future with gold and do it with one of the best in the industry, Allegiance Gold. Allegiance Gold has done things right from the beginning, having earned 5 stars with TrustLink and an A+ with the Better Business Bureau. Allegiance Gold can help protect your IRA or 401k with physical gold and silver, or you can have it delivered securely to your doorstep. Get up to $5,000 in free silver on a qualifying investment when you visit protectwithrobert.com today. Or you can call 844-3-ROBERT. That's 844-3-ROBERT. Hi, everyone. I'm Kim Kiyosaki. Thank you for being with us today. As CEO and co-founder of the Rich Dad Company, I can assure you, Robert and I are both dedicated to our Rich Dad mission to elevate the financial well-being of humanity. And you are the humanity. We truly want you to succeed. When you succeed, we all succeed, and our mission grows stronger. With that in mind, I'm excited to extend a personal invitation to you to elevate your financial well-being by attending our exclusive free online wealth building event hosted by Robert. You'll learn what to focus on first to start increasing your cash flow immediately. You can reserve your seat right now by going to richdadonline.com. Just go to richdadonline.com. The event is 100% free and will help you achieve your financial goals.
Welcome back, Robert Kiyosaki, the Rich Dad radio show, the good news and bad news about money. Today we're talking about the good news and bad news about gold, or what it means to the economy if the price of gold goes up. Our guest today is dear friend, Jim Rickards. He's the author of incredible books. The first book I read was Currency Wars. It's how we fight. You know, there's no more, not shooting people's planes down. We just shoot them down by changing the value of our money, purchasing powers.
And his latest book was Aftermath, which was published last year. So we'll see how that plays out.
And then you can listen to the Rich Dad Radio Show anytime, anywhere on iTunes, Android, and YouTube. And please leave us a review when you listen. And all of our programs are archived at richdadradio.com. We archive our programs so you can listen to them again, because repetition is how we learn best. You listen to this program again, you'll pick up twice as much. But more importantly, ask friends, family, and business associates to listen to this program and discuss it. If you listen and discuss, you'll be a genius. So anyway, just go to richdadradio.com. Any comments, Kim?
Well, I love listening to Jim because he's a wealth of information, but also he just makes sense. It just makes sense. You know, people say, oh, the price of gold is going through the roof, but they have no backing or no calculation for it. And this just makes sense. And I also like, Jim, what you said about Buffett and Berkshire Hathaway. He's just looking where to make money. Right. All right. The banks aren't going to make money, but the mining companies are going to make money. And especially if you're into the junior mines, you might want to get into that, right? Because they're going to be bought up by big guys.
That's what Kim and I started. We didn't start a junior mine. We started a mini mine.
And it turned into a big mine.
We made a big mistake of hitting a lot of gold in China. And then the CCP, the Chinese Communist Party, helped themselves to it. So they don't take intellectual property, they take real property too.
Well, they take both.
They do.
And we had already listed our business on the Toronto Stock Exchange, and they didn't care that we were a publicly listed company. They just took it.
Right.
Anyway, we're going to get into bonds versus gold, because Jim mentioned one of the most important dates in history was August 15th, 1971, That was the day that President Nixon went on the TV show Bonanza and said, hey, by the way, I'm going to steal all your money. I'm going to take the dollar off the gold standard. And after that, then bonds became better than gold, technically. You know what I mean? And so that's why so many old guys are trapped we've been in this raging bull market in bonds. And that may change if the yield curves change again and interest rates go up. So the contention has been between bondholders and gold holders. So Jim, could you mind explaining a little bit more differential between bonds and gold?
Sure. And when they, pardon me, Robert, just to be clear, when I talk about bonds, I'm talking about the U.S. government securities, U.S. Treasury securities, or I might talk about Japanese government bonds, so-called bunds, which are German government benchmark bonds, et cetera. I'm not really talking about corporate bonds. We could, but the problem with corporate bonds, they have the economics of bonds, but they also have all the credit risk of stocks, and they're very idiosyncratic. There's probably some good corporate bonds out there, and there's some you wouldn't touch with a 10-foot pole because they're going to go bankrupt. So I'll keep away from the corporate sector. I'm familiar with it, but that's not my area of expertise. So I'm talking about bonds. I'm really talking about U.S. Treasuries, unless I specify one of the major other global benchmark bond markets. But bond math is not as hard as some people make it sound. This easiest rule, a little counterintuitive, but when interest rates go down, the price of the bonds goes up, and when interest rates go up, the price of the bond goes down. And the reason for that is if you have a bond with a certain coupon and interest rates go up, a new buyer is going to want that new bond. It's going to, hey, give me that higher coupon. Well, I got this other bond over here. It's got a lower coupon. We'll say, well, you have to sell that to me at a discount because I need to get comp for the fact that it doesn't have as high an interest rate. So simple as that. Interest rates up, prices down. Interest rate down, prices up. That's how the bond market works. But the point being, and just one more little quick piece of bond math. So how much, I said prices of bonds go up when interest rates go down, which is true. How much? Well, the answer is it's not constant. It varies depending on the level of interest rates, something called the DV01, the dollar value of 1 basis point. How much does my bond go up for every 1 basis point decline in yield? Well, so let's say I cut interest rates from 9% to 8 3/4. That's a 25 basis point cut. Let's say I cut interest rates from 25 basis points to 0. That's a 25 basis point cut. Those two 25 basis points do not produce the same gains. The second one produces a much larger capital gain because the DV01 is higher. So in other words, when you're at low levels of rates, every basis point decline in rates produces a bigger capital gain than if the same thing were happening at higher level of interest rates. Now, your original question, Robert, was, well, what about gold versus bonds? What's up there? To me, I don't have to resolve that debate because I would say have both. Of course I like gold and I recommend gold, but I recommend 10%. Some investors are higher, seasoned to taste. But the point is, if you have 10% in gold, you've got the other 90% of your portfolio. What are you going to do with that? Well, I would have a slice for 10-year treasury notes for the reasons we just discussed. I'd have cash. There's room for equities and alternatives and all that. But you can have bonds and gold side by side. And that may be an ideal portfolio.
So no, this is what I'm asking you the question because I'm a very simple guy. It was in 1972. I bought my first Krugerrand in Hong Kong because it was illegal for Americans to own gold. But the reason everybody says you don't buy gold is because it had no yield. And is it accurate with you, the more that the price or the yield on bonds or your interest on bonds goes down, doesn't that affect the price of gold?
That's generally correct. So if bonds are competing with, if gold is competing with money markets, let's say, well, let's flip from bonds to the money market because that's the most liquid form. Money market funds, bank CDs, short-term investments, et cetera. If gold is competing with these money market or substitutes of money market funds, and their rate is 0, and gold's yield is 0, then it's a fair fight. Now it's all about capital gains. Now, obviously, we already talked about in the last segment how you can make 10 times your money in capital gains on price of gold. But if you're comparing yield to yield, even assuming the price is going to be constant, it's a fair fight. If they're both at 0, then take your pick.
So what I'm asking you is this: when I was this young kid, I never understood bonds. I understand debt.
Right.
because I'm a real estate guy, and the interest rates went down, I got happier as Larry. We could buy more real estate. And I never understood, why would I put my money in a bond? But I understood gold because nobody could mess with it. There was no counterparty risk to it. It was
Right.
just gold.
Well, when you're borrowing money for real estate, in effect, you're issuing bonds, because somebody's taking the Kiyosaki note. He's the bondholder, but
Yes. I issue bonds.
Many years that you want to be in the real estate side of that. You want to be the borrower, not the investor.
That's
not
correct.
The bond investor, right?
And so I'm ignorant when it came to bonds. That was a whole thing. But now Kim and I have a lot of gold and a lot of silver, just because we saved money in gold and silver. We just kept using debt to get rich.
Sure. Well, you kept issuing debt, but now we're talking about buying debt.
Correct.
Right.
Correct.
And for the investor, for someone with money, absolutely have your gold and silver, but I'd have some treasury notes side by side.
I just want to jump in here for a second, because Jim, you made a comment early and it just kind of passed by. You said the new Great Depression. Are we in a new Great Depression?
We are. And by the way, thank you for mentioning my last book, Aftermath. And if you have a copy of Aftermath handy, go to pages 288 to 291. Now, this book came out in July 2019. In those pages, I say there'll be a pandemic in the next 3 years, and there'll be social disorder and riots in the streets.
Oh, it's your fault. It's your fault. We knew it was.
Well, anyone who read that book can't say they weren't warned. So again, read the whole book by all means. But
look, Jim, can I say one more thing? In the book, The Road to Ruin, you warned also that there were military vehicles stationed all around America getting ready for the riots.
Sure, and they we were even closer with the book Aftermath. So everything we're seeing now was in that book. But Kim, to your point, the title of the book is The New Great Depression: Winners and Losers in a Post-Pandemic World. A lot of people don't know what a depression is, because they, first of all, no one's ever lived through it. If you have a living memory of a U.S. depression, you are 90 years old. And my mother's 90, so she remembers it. We still talk about it, but you're 90 or older if you remember the depression. So very, very few people in that category. Most people have never lived through a depression. They don't know what it is. They assume must be a continuous declining GDP. It's not. Two quarters of GDP, of declining GDP, is the technical definition of a recession. But a depression means depressed growth. You can have growth in a depression. It's just the growth is below potential. So if your potential is 3.5%, and your actual growth is 1.75%, that gap between, say, 3.5 and 1.75, that gap is depressed growth. Now, if your debt is going up 5, 6, 7, 8% a year, which it is, and if your growth is 1.5, 2% a year, which it is, which it will be in my forecast, then your debt to GDP ratio, when your debt's going up faster than your income, you're going broke. It's as simple as that. So, but people aren't. We're looking at intergenerational changes, and again, it all comes out of the COVID pandemic. But the pandemic, the social unrest, and the depression that all converged in 2020. But a lot of people don't know the stock market reached a certain level in 1929. Do you know when then it crashed 90%? Do you know when it regained the 1929 level, when it got back to the 1929 level? 1954. It took 25 years to get back to where it was in 1929.
The Dow hit 381, and it took till 1954 to hit 381 again.
Correct.
Yeah.
But,
So
it went down to about 30. I remind people
Perfect.
that Joseph P. Kennedy became one of the richest men in America by shorting stocks ahead of the Great Depression. So you can make money in depressions. You just have to see it coming.
Yeah. Anyway, the last question is the debate between inflation and deflation. And I don't know if you pay attention to Peter Schiff, but his definition of inflation and deflation are different than your definition of inflation and deflation. And so the question is, are we heading for wheelbarrow money, where it takes a wheelbarrow of money to buy a loaf of bread? Or are we, what else are we going into? So
we're probably, I had a debate with Peter on this recently. It kind of reminded me of I forget the character, the Mad Hatter, maybe from Alice in Wonderland. I said, words mean exactly what I say, no more, no less. Peter has a definition of inflation that may work for him, but it doesn't work for the Federal Reserve, the European Central Bank, the United States Treasury, or anybody who's trying to figure things out. So I use consumer price inflation. I mean, just to be a little technical, the Fed uses something called personal consumption expenditure deflator year over year. That's a technical name, but it's basically just their personal core, by the way, core PCE deflator year. It's just their personal definition of inflation. That's the one I use. It doesn't matter if I agree with it or not. If I'm trying to figure out the Fed and the markets, I better use the same tools the Fed is using, or else I'm going to miss it. Money supply has nothing to do with inflation. Inflation is caused by velocity, which is the turnover of money. So let's just say you took the money supply from $4 trillion to $7 trillion. Nominal GDP is money supply times velocity. This is just the quantity theory of money. This is Milton Friedman's famous equation, which actually goes back to Irving Fisher in the 1920s. Well, they took the money supply to 7 trillion. Okay, what's 7 trillion times zero? It's zero. In other words, if you don't have velocity, you don't have an economy. The thing that drives inflation is not the money supply, it's the turnover of money. That's the velocity. That's the zero in my case. Velocity has been dropping since 1998. It didn't start in 2008. It didn't start in 2020. It's been dropping like a stone since 1998. And it's getting closer to zero. So
wait, Jim, what does velocity mean for the average?
Velocity is the turnover of money. So let me give you a very simple example. So let's say I go out for dinner and I tip the waiter. And the waiter takes my tip and she takes the taxi cab home and tips the taxi driver. And the taxi driver takes the tip and fills up his car with gasoline, okay? In that example, my dollar had velocity of 3. There was the waiter tip, the taxi driver tip, and the gasoline. So my dollar supported $3 of goods and services. So that's velocity of 3. What if I stay home and watch TV and don't spend any money? The velocity is 0.
Velocity.
In other words, that's the point. It's not how much money you print. It's whether people are lending and spending, and they're not. And it's psychological, and the Fed cannot control the psychology. And you've got to change the psychology, get out of that deflationary problem, which, by the way, the only guy who did it successfully was Franklin Delano Roosevelt in 1933. And how did he do it? He raised the price of gold.
So they're sitting on it. They're not.
Correct.
They're not spending it.
Well, you're right. You're absolutely right, Kim. It's in the data. The personal savings rate. So savings rates have tripled or quadrupled, and that is what's actually happening. Those are Chinese levels of savings. So people are not spending the money, and they do. If they write a check, they're paying off debt. They're not using it for consumption.
So the final question to you is that when I buy gold and silver, the velocity stops?
Yeah, because I'll speak for myself. You buy gold, you put it in a vault, and you sit on it. Well, I'm not spending the money.
That causes deflation.
Correct, and that's why Franklin Delano Roosevelt confiscated the gold
and changed the price of gold
before he raised the price, because it was the ultimate insider trade.
Everybody, I mean, like I said, Jim Rickards is the man of this time, and it's an honor to have you part of the Rich Dad radio program. Hey, nice to call you as a friend. So we're going to thank you, Jim. Look forward to working.
Jim.
Thanks, Robert. Thanks, Kim.
All right. Have a wonderful day.
Thank you. We'll be right back. Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. You can listen to the Rich Dad Radio program anytime, anywhere on iTunes, Android, and YouTube. And please leave us a review if you like what you heard, or if you dislike what you heard, and listen to our podcast. All of our programs are archived at richdadradio.com. We archive them because we don't sell anything. We're a pure educational company. So if you listen to this program again, you'll learn twice as much. And if you discuss it with friends, family, and business associates, you'll learn out what idiots they are. Anyway, that's the good thing about discussion, and you'll learn a lot more about your idiot friends. Any comments, Kim?
Well, this was fascinating. I mean, I love talking to Jim, and he goes way into the technical, but he just made some excellent points.
Anyway, ladies and gentlemen, it's always good news and bad news about money. Thank you for listening to the Rich Dad Radio program, and thank you to our friend Jim Rickards. What's his website, Kim?
Website is
the JamesRickardsProject.com.
Oh, JamesRickardsProject.com.
He's a very smart guy. Thank you very much. Thank you for listening to the Rich Dad Radio program.
This podcast is a presentation of Rich Dad Media Network.